This will be our 5th Precision Trader session. Koala. No. Hold on 1 second. There we go. Little issue with the throat. I get tired. My throat gives out real easily. Lots of good stuff today. Getting a few more things done for this group. For those that didn't see it yet, in the Facebook group, we have a resources page now. And we'll be keeping that current as we move forward. A little bit of a conglomeration of stuff from multi-purpose sources sometimes. Or if it's something of special emphasis, then I'll make sure it gets there and tell you about it. So pretty good turnout tonight. Got about 3/4 of the group here. That's pretty good considering the geography that we cover. How's everybody else doing? Let me get an update on mood, sentiment, attitude. Give me the barometer here. It's always tired too. Uh-oh, somebody's sick. Get well soon. Good. Less overwhelming. Good. That's important. Head colds are the worst. Ugh. Kids making you sick. I don't mean mentally, I mean physically. Sorry about that. There you go. I like optimistic. Good. Good. It's not as complicated as you think, and it's just the overwhelming, because you know there's this big universe of stuff you don't yet know, and that is always scary. So, trying to get into a trading routine and get up to speed. Well, here's the nice thing is, next week is my last week before my Christmas break. It's going to be a pretty business break for me, a pretty busy business break for me. Just as a break, I'm next Thursday's session. Well, Friday morning next week, I'm headed out to Boise, Idaho. It's about a 700-mile trip with my son to do a college visit. And we'll be coming back the 19th. And then the 20th, my daughter from the East Coast flies in. And she'll be here through Christmas through the 27th. I'll get stuff done during that time. But the more important thing is you guys have some time. So that'll be your time if you've fallen behind some to catch up. That'll be your time to get lots of stuff done. We're going to be tested a little more as we move on here. Because, you have pitchforks, and some of you are still getting up to speed on pitchforks, truly up to speed. And I know those of you who are drawing pitchforks think you have it mastered. I'm going to tell you don't. There's still much more to learn in application and technique in the nuances, and so you just have to keep drawing your pitchforks, which means you can't stop drawing them just because quickfire came along. I don't know if you ever remember I think I remember it more in like, seeing old movies more so than I ever recall seeing it in real life. But remember, there was a guy at the circus, and maybe you've seen this in a movie somewhere here or there yourself. There was a guy at the circus, and there was this kind of like a little table or stand. Again, excuse my inability to draw in 3D. And that guy had these sticks, and the sticks, all right, there we go. He had these sticks, and they were, like, I don't know, wooden dowels of some sort. And, typically they'd have, I don't know, 4, 5, 6 of them. And he would come along to the first stick, and there was a little plate on it, and he'd spin the plate, and then as the plate started spinning, he would grab the stick somewhere in here with his hand and push it back and forth to accelerate, to get a little clockwise motion or counterclockwise motion with the plate, and he got it going. And then he goes and throws a plate on the second stick while the first one's still spinning, and he gets that one spinning. And then he puts a plate on the third one, and he gets that one spinning. And on the fourth and fifth and sixth. And about the time he gets the sixth plate spinning, this first one is all wobbly, and it's just in, well, I can't do it very well here. It's in different direction, it's just a real bad wobble. And so he runs over to this first one, and he gets it going again, revs it up just by shaking the stick, only for a few seconds, and then the plate takes off, and he goes here, 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 and he gets down here, and now he can actually stand there and watch them all spin. In another 5, 10 seconds, he comes back to the first one. Okay, so here's the deal. You've kind of been a little bit here on this first plate for most of this time. We kind of threw a little zinger by going from just pitchforks, to all of a sudden, hey, here's quickfire. And, oh, by the way, here's Charlie Delta, right? As we've gone weeks by weeks by weeks. And now, there was a little bit of Elliott wave. We just touched on it to kind of get some concept set in your mind. And now here we are, harmonic wave convergence. At least initial harmonic wave convergence. So you do have a lot of plates to spin. Okay. I did warn you up front it was going to get intense. So, matter of fact, I won't name a name, but I heard one of you ran to your therapist the other day and you said, I'm a wigwam, I'm a teepee, I'm a wigwam, I'm a teepee. And your therapist said to slow down, that you were too tense. Boo. Yeah, I knew I was waiting for the boo to come in. Anyway, so don't be overwhelmed. The nice thing is we have everything, recorded, and you can go back and get as much replay as you want. We have a group that you get to ask questions for clarity, and you get to proceed. And so don't worry about having an overwhelming feeling. But at the same time, don't abuse that. Don't say, oh, okay, I got all the time in the world. Because you turn into a procrastinator as we get going here. It's not going to work. So tonight we had just a little bit of an introduction to harmonic wave convergence last week by principally just giving you a title of what it really was. And it's time to move forward a little. So here we go. Try and be brief tonight. So we got harmonic wave convergence and the MultiWave indicator. So we're going to start off with MultiWave. There's two components to harmonic wave convergence right now. The first one is MultiWave. MultiWave was my first iteration with harmonic wave convergence. And as we said the other night, MultiWave convergence is really the multiple time frame wave exhaustion synchronization. And again, that's why we kind of had that little prequel with Elliott Wave. So you've got the idea that there are fractals involved. We scale up and we scale down, but everything's the same at each scale. And so it's pretty powerful. And with Elliott Wave, we can't have a larger wave terminated and ready to reverse until the last of the lower wave and the last of that lower wave and the last of that lower wave have all met. So that's the theory of Elliott Wave. What we do is we take the science of that and apply it to strength, relative strength, if you will. And there's lots of ways of measuring relative strength. And we've created our own. I created our own. And the difference is we're going to put that in a multiple time frame analysis way to give you insight in a multiple time frame analysis ability or capability on one chart in one indicator. We'll drill it down that far. And so here the definition was the occurrence of two or more levels of cyclical waves, harmonic, exhausting, terminating at precisely the same time and price. When this convergence takes place, price will almost always reverse. So for the most part, we only have two waves in the indicator here. Typically, we go up to 6 with MultiWave. And for the most part, if you look at this as a newbie, you don't really get what it is. Okay, it kind of is not the prettiest plot like you're used to seeing maybe, but there's a big story in these waves. Okay, now the way you're going to trade this indicator is by learning the patterns that it makes. And the way this process as a learning process is going to work is your RES is going to get expanded, and you're going to see price action in the top part of your chart. And then you'll see MultiWave in your, in the bottom half of your chart in the indicator field. And you're going to see MultiWave in some cases at time period. And it's going to look like this. Now, the first time you see that, you're going to say, well, there's nothing great there, Steve. Your indicator is doing nothing more than mimicking price. That's going to be your first reaction. Because you're used to seeing indicators in that fashion. First, I look at the price field, then I look at the indicator. And so you have this concept of this is just essentially copying the price action. And then we're going to show you some of the patterns that occur in the MultiWave indicator. And soon enough, you're going to see something. You're going to see that it's not only looking like it's copied, but you're going to start to be able to, your RAS will expand, and you're going to start to be able to say, well, every time price ends up hitting a hard wall and reversing here, I notice I'm at the top of this indicator and price reverses. Now again, to the untrained eye, it's still going to look like this is copying the top. But what you're going to learn to do is to read this little bit of the indicator and say, aha, price is at the top, we're about to have a reversal. And so what happens now is the indicator becomes predictor. So up front, it just looks like it's copying price. But these patterns are so accurate and so consistent that, thanks for the ooh-ah. These patterns are so consistent that you now predict. Now here's the nice thing about these indicators. They are real time. There is zero lag. And because you developed the RAS that will let you see this pattern and make it the predictor and know what's going to happen next in price, instead of real time, they really become leading time. So it's a double one up over the old paradigm where those indicators lag, and we'll take a look at how that happens here in just a minute. So not only are they real time, not only do they have zero lag, they are leading time. They are leading predicting indicators. So you know in advance what's happening. Remember last week we kind of ended with a candle or a series of candles, and I said, what's happening right there? Is that about to start a big retrace? A deep retrace? Is it about to start a shallow retrace? Is it just a little tiny breathe and about to take off? Or is this a full-blown reversal? This indicator will tell you which of those four it really is. In about that amount of time. You will be amazed. Now, here's the thing. And you have RAS to grow, not only to grasp what this indicator does, as we present it to you, as I present it to you, but you have to continue to grow and overcome what is the kind of the main failure of most traders. And that is when you have something already assuming it's the Holy Grail. And in all cases, and in all times, it should be working. I remember way back, not that long ago, 3 or 4 weeks ago, we had somebody post in the Scans, Forks, and Fibbo group their first pitchfork. And their comment was, this is my first pitchfork, but it just didn't go the way I expected. And that's the wrong perspective to have on anything, whether it's a pitchfork, whether it's a harmonic scan, whether it's the multi-wave indicator. We don't care. See, you want to focus on the stuff that works, not the stuff that doesn't work. So get used to a term. Don't be offended if I remind you of it. But if you hear me calling you an exception hunter, It means you're looking at the wrong thing. It means you're looking at, oh, it didn't work, instead of, oh, it worked. And the thing with exception hunters, it's just not a semantical, oh, the glass is half full or it's half empty, because that's the same thing. An exception hunter, for whatever reason, focuses on the fact that though it works 8 out of 10 times, their focus is on the 2 times it doesn't work. The focus is in the wrong place. They're their own Debbie Downers. Yes, Tiffany. They're their own Debbie Downers. Now, what that means is it's going to work with a high degree of frequency, but it doesn't work 100% of the time. Now, when I say doesn't work, what I mean is something happens in the indicator that doesn't generate a pattern that you're familiar with. And then price does something anyway. That's okay. You know, one of the things I do to kind of like get a total change up in my life, from coaching, from trading, etc., is, you know, since I moved out to California and I'm like 45, 60 minutes from the California Mother Lode, that's the place of the great 1849 gold rush, I spend some weekends up in the hills, 1 to 2 a month, just depends. And I do a lot of different kind of gold prospecting, and one of them for sure is metal detecting. Finding the gold in the streams, finding the gold in old benches on the riverbeds where over millions of years the rivers have shifted elevations, and some of the old benches with the cobbles still sit right there on the hillside. You're sitting at the creek, and 30 feet up is a bench where the creek used to be. Prime territory for finding some gold. Well, here's the deal. What I celebrate is when the metal detector finds gold. I don't worry about the times it doesn't find gold. It means that in the realm of the indicator, I'm going to redraw another one just because I want to make it bigger, but I don't want to erase what's up here just yet. Whoa. Means in the realm of the indicator, and don't try and read anything of this, I'm just doing scribble work here. What's going to happen is this. You will learn various patterns. We have names for some of them. Convergence, snake in the grass, disproportionality, etc. You're going to have various times on the chart where the patterns that the indicator makes are very, very, very highly predictive of what is about to happen. And when you see one of those patterns, that's time to act. What it also means is if that's the case, there's times where there's no patterns that are recognizable that are generated. So when I used to do a lot of open webinars to promote this particular product, I would always have the hecklers in the crowd because I said, oh, it's a real-time indicator. It has zero lag. As a matter of fact, it's leading time. They would always say, well, not they, but one or two would always say, well, open a chart and tell me what it's going to do tonight. And I said, no, it doesn't work like that. These are real time. They're not forecasters. They don't tell me what's going to happen 6.5 hours from now. They don't tell me what's going to happen tomorrow. In some ways they can, but we don't trade those time periods very frequently. So at a 30-minute level, 15-minute level, they're real-time indicators. And there's plenty of times I could go to the charts, open them up, and right now there's a pattern that's tradable. There's times where you open the charts and there's nothing going on in the patterns. And so don't try and force a trade when there isn't one. Don't get all this wrapped up that this is some holy grail that 24/7 it's always telling you what's going on. You don't care about that because when these patterns emerge that I have in white boxes and they give you 12 pips or they give you 37 pips or they give you 15 pips, you don't care about the times that they can't tell you what's going on. Now, if you've been around the Forex at all, I'm not telling you anything new. I'm just reinforcing that this is no different. The MACD doesn't always tell you what's going on, or better said, you can't always read it to know what's going on. There are times with stochastics, even RSI, you can't tell me, hey, it's overbought. Okay, that's nice. 50 pips later, it still may be overbought. That's the trouble with RSI at 70. It could go to 75. It could go to 80. It could go to 85, which is why it's such a challenge on patterns. And this is why we don't play around too much with patterns where the price in the scan, where the price goes past and breaches the green line by a significant amount. Couple pips, okay. 5-7 pips on a 15-minute scan, the green line is invalid already. It's just, it's breached one of those 3,000 lines of support and resistance. So this is not some anomaly that exists with harmonic wave convergence or multi-wave. Harmonic wave convergence is a tops and bottoms reality. And sometimes the tops are so perfect, you'll pick them out and forget 12 pips, it'll be 150 pips. Depending on your mindset and you're not fearful of staying in a trade. Not the price has generated a pattern, it's the indicator has generated a pattern that we don't understand. And so we're just interested in it at the times it'll tell us what's going on. And it's like the other times, don't worry about it. Now, the nice thing is, those other times where we don't know what's going on, we're not trading, we're also not losing money. So get your paper and pencil and write this down, because this is the number one axiom of my money management for trading in general. And that is, with harmonic wave convergence in the new paradigm, our goal is to preserve and protect capital and then grow the account. Our goal is to preserve and protect capital and then we grow the account. So what that means is, first of all, we don't gamble. Remember, you've heard me say, I only take trades I'm going to win. We don't gamble. We don't think. We don't hope, dream, or wish. We don't do the he said, she said with analysts from other sites. We don't do the he said, she said from somebody in some Forex group, IML or otherwise, within Facebook. We only trade when there's a trade to take. And when there's not, we really don't worry about what price does. I don't care if it moves 50 pips or 100 pips. I don't have FOMO over that. I just wait until my indicator takes the next trade, because you look at those pip totals and you remember, my friends, you only need 5 pips a day to become a millionaire. And so when you're trying to get greedy, when you have FOMO and you're trying to desperately get into pips, oh, the indicator didn't tell me to get in, but I think it's going to go up. I heard Billy Bob said price was going to do this. That's gambling. You thinking price is going to do something, that's gambling. And guess what thinking does? It invites ego and emotion to be your trading partner. And as I've said a gazillion times, ego and emotion are the worst trading partners you can ever have. How many of you know what whack-a-mole is? All right, so once you start playing whack-a-mole, you know, it's a little table, it's got holes in it, and a little mole pops up randomly in the various holes, and you try and hit it with the bat before it goes back down, right? Do you just, as the game starts and it's speeding up, do you just randomly whack at holes? Or do you wait for a mole to be in one and then whack it? See, if you, I have a strategy. If you are trying to catch the mole or whack the mole, you don't waste your time about the holes that don't have them popping up. Now, you might whack a hole and every once in a while, coincidentally, he actually starts to show up as you swing your bat at it and you actually get him. But see, that's called a lottery ticket trade. You've got to turn the discipline on and the emotion off. You've got to turn the logic and the math, the discipline, to tell yourself you're not interested in trades that you can't take, regardless of how far they go after you decided not to take them. That's exception hunting. You're only worried about the trades that you take and getting a very high percentage out of them because they're very accurate and predictive. All right, so the first money management axiom was we conserve and protect our capital and then we grow it. See, that's quite the contrast of the old paradigm. The old paradigm was take a shot, take a shot, take a shot, take a shot, hope something catches. The second axiom is of money management for our trading. At the end of the day, my equity ball, and that's just another way of calling our account balance, or naming our account balance, our equity ball, the amount of money we have. At the end of the day, my equity ball needs to be the same or bigger. That's my goal. Because see, when you absorb that and condition yourself with that, you'll stop gambling. And what's really powerful about it is that's something that 99% of traders cannot do. End the day with their equity ball the same or larger. Now, there's some inherent meaning in that. And what it is one of the things that we're very good at, and what MultiWave and tab 29, which you'll get to after you get through MultiWave, is not only do we have very accurate ways of getting into trades, but because they are real time with zero lag, we also have patterns that tell us when to get out of a trade. And the nice thing about MultiWave, it's a very humble indicator, meaning it has no problem saying, hey, Jake, hey, Jerry, hey, Richard, hey, Ryan, hey, Tiffany, I want you to get in this trade now. And you should follow MultiWave's directions because it's very accurate. But it's very humble because it has no problem 2 minutes later saying, hey, Jake, hey, Jerry, hey, Neil, hey, Tiffany, I know I told you to get in that trade a few minutes ago, but right now I'd like you to get out of it, please. So what we're very good at is not losing in trades. And that's very, very powerful. That's very, very powerful. We do not lose very often in our trades. And that, my friends, is why if you took 10 trades today, and at the end of the day, your net was 0, what it meant was you were in a whole heck of a lot of trades that you shouldn't have been, and you managed to navigate out of them, and in those 10 trades, you didn't earn a single pip. It's not like you made 5 trades with 50 pips and 5 trades with minus 50 pips and you netted 0. You took 10 trades. I'm totally exaggerating because you're never going to take 10 trades, but I'm embellishing to make my point. If you took 10 trades and ended up 0, it's because MultiWave told you to get out and it told you to get in and it told you to get out and you didn't lose anything. And yet, mark my words, some of you in here will be whining about, oh, I took 3 trades and I didn't make anything. That's your impatience, that's your false expectations, and you're forgetting that 99% of the market can't do what you just did, and that was take 10 trades and end the day having not lost anything. Welcome to the new paradigm. Who's with me? See, if you could take trades when the criteria is there and not lose, do you fear trading? Do you fear entering a trade when the criteria says to get in? No, because that same criteria that told you to get in is very humble, will admit its mistake to you and say, now get out, and let you get out. I have traders who go, I took 3 trades and I only made 2 pips. And I'm like, man, you need to be doing the happy dance, the Charlie Brown dance. I say Charlie Brown dance. I actually saw something the other day that reminded me. It wasn't Charlie Brown. It was Snoopy that did the dance. Charlie Brown just joined him a lot of the times. You need to do the happy dance because you just did something that 99% of the traders in the Forex can't do. And that is take a bunch of trades that weren't going anywhere and you didn't lose them. Yeah, exactly right. That's why you need to smash your ego, because MultiWave doesn't have an ego, but you do. Exactly right. And that's the power. See, if you go take that old paradigm trade, 4 hour, you know where the support and resistance is, blah, 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 yada, 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 and you take that 4 hour trade with the 150 pip stop loss and price reverses and takes you out, It's a mental disaster. It's an emotional disaster. Because now, next time the criteria is there, you're thinking, should I or shouldn't I? And the reason you're thinking that is because you just lost 150 pips, which means you have to make 150 pips just to get back to break even. And oh crap, last time I took it, it didn't work. I don't want to go down 300 pips. And the reason you have to have that 150 pip stop loss? Lagging indicators, slush, etc. All right, let's move on. I got so much to cover. So let's look a little, because a lot of traders don't understand this. Let's look a little at a standard indicator, and I've got two of them on here, MACD and a stochastics. On the left is a 30-minute chart, and on the right is a 5-minute chart. And what it says is indicators are local to the time period of this chart. What that means is on the chart on the left at the 30-minute period, look at my MACD. Now, what I've done is isolated the time frame that we're looking at. In other words, you see these faint red lines. I'll draw a white box around it. That time on my 30-minute chart is represented by this time on my 5-minute chart. And you can see down below the times. We're ending right here around 14:30 or whatever, and there we are. You can surely see in the MACD on the left, it doesn't look anything like the MACD on the right. And that's because at each time period, the indicator is measuring the waves and the strength and the move at that time period. That's the way charts work. So you don't just look at your 30-minute chart and think, well, I know the 5-minute chart has 5-minute candles, so it has to operate tighter, so I'll just go read my 5-minute chart for my 30-minute trades. It's not going to work. They're measuring different waves. They're measuring 5-minute waves versus 30-minute waves. And since you have your Elliott wave mindset now, you understand what this is measuring is, in terms of price wave, this is that big wave. And inside that big wave, we have smaller waves. And what this indicator over on the left is doing is finding the tops and the bottoms of that big move. Over here, the indicators are finding the tops and the bottoms of each one of those little waves in the same time period. So a MACD, with whatever setting you want to put on it, on a 30-minute chart is not the same as a MACD on your 5-minute chart. And as a case in point, if we look at things like stochastics here, let's look at entry points in the trades if you were to just be using stochastics. So on your 30-minute chart, here's an entry. The faster wave finally crossed up. Faster wave finally crossed up. And it's kind of a neutral zone here. And then it crosses up, stays up, and finally crosses down here. So there's your up move, and it stops, and now it comes down. It's crossing down as we end that time period from red line to red line. What happens in the exact same time period, again, red line to red line, look at how many times the stochastics turned over. It turned over for an up move. Turns over for an up move. So a little bit of an up move there, a little fake out, a little bit of an up move here, a little bit of a fake out. Turns up for an up move. That was a bottom, it reached a top. Bottom reached a top. Bottom reached a top. And then when you look at the totality of that, There's the number of up moves and down moves in the same time period for the same indicator. It's just you're measuring different things because you're on different time periods. You're measuring different size waves. Kind of hard to correlate the two in a trading sense with your RIS, and that's just 2 time periods, one indicator. Now, as an example, if we look at the lag in the upper time period, in other words, from the time it said we were down until the time we actually got the cross, that was 28 pips on the 30-minute chart. Let's look at the same start of the smaller wave at the very beginning of the bigger wave. Over here, same reaction. We were down, and we actually have the flat, and now we have the crossover to the top. That took 8 pips. So right away, we're starting the same wave in the same spot. If we're using the 30-minute indicator, we're going to be 28 pips late into that trade. If we knew where that flop occurred at the 30-minute level, and we can isolate that time and then look for the indicator's move on the small time period, we could get in that trade just 8 pips late. So it's an example of a couple things. One, that the indicators do not measure the same price move. They measure the waves within the price moves. And when you measure it time period to time period, in other words, that stretch of time, which is that stretch of time, there's going to be one up and down, or one up move at the big level and multiple moves in that same time frame, up and down. A wave up, a wave down, a wave up, a wave down, a wave up, a wave down. Wave strengths, at least. Price doesn't have to look like that, but the wave strengths are there. Tops and bottoms of waves. Does that make sense? You guys kind of grasping that reality? When you put, in this case, the stochastics on the 5-minute chart, it's not giving you the same reading on the 30-minute chart. It's measuring the strength of the waves and the exhaustion points of the waves at time period. That's all our charts do. Same thing coming down. Using the MACD. 55 pips of lag to get into this trade from the time it bottomed out until the actual time it crossed over. You can't enter anywhere in here. You can't enter anywhere in here a buy because this may just turn back down. Just because it's getting close, it might turn down. You have to wait for that cross. And from the bottom of the turnaround here to the time you can enter the trade is that 55 pip lag. That's just on a 30-minute chart. The waves are much smaller on the smaller time periods, and that's why their slush is much smaller. 12 points to enter here on the MACD, 55 here. The other one was 28 and 8 or 23 and 8. So hopefully you get the picture here about what's going on between multiple time frames in terms of the waves. So this is a bit of a flashback, but I love this. I love it because it's not only does it show how technicals rule and fundamentals don't matter, but it also talks to how, at least in the States, our government always has to feel like there's an explanation for things even when they don't have one. So this was the flash crash, May 6th, 2010, in the stock market, where it dropped drastically in one given day. And so what you can see here is there was an Elliott wave coming down. You can see some of the moves on the way down. Here was the 3, 4, and finally at the 5. So we start a new wave down here. Okay. And it so happened to be a correction. Remember, 1, 2, 3, 4, 5, A, B, C. So what was pretty interesting is there is a traditional pitchfork. Swing high, swing low, back to the previous swing low. So traditional pitchfork, third grader could have done it. Notice how well it holds. The Dow, look at that resistance. Unbelievable. Final pullback, makes a run up. Now watch closely. Can I zoom in? There we go. Now watch closely what happened. There's some passing off of resistance levels. So we had this strong resistance level in here. It's still holding 1, 2, 3 candles. Guess what we got close to at that time? A 61.8 retracement. It got so close that finally it broke the pitchfork, only seeking out that 61.8, and it found it on 3 candles. And finally, the pitchfork catches up with the 61.8. There is your energy point. There is your drop. So what happens is all these people lost a lot of money. Now, it did recover pretty good later that day. It recovered a lot, but there was still a loss. And, of course, once price starts dropping like that, people start selling like crazy. So the people that stayed with their stocks, you know, they didn't fare too bad. They lost, but not tons. The people who saw this thing tanking and said, I got to get out, and we're trying to sell it. First of all, when a stock is tanking, it's hard to get rid of. Who wants to buy a sinking ship? But many managed to sell off, and then, of course, only to watch it go back up, and they lost millions and billions. They demanded to know what went on. They wanted to know what the heck went on that caused such a drop. You don't see technical analysis on the news. When's the last time you watched a business network on cable TV and saw a pitchfork? They only deal in fundamental. So the government had to have an explanation for this drop. And it took them like six months or 13 weeks. I don't know what the total, it was a long time. And they concluded that, oh, some guy on the floor punched too many zeros in something and it should have been, 6 zeros and he punched in 9. And that was the reason, because the computers went crazy, and that's the reason for the drop. Well, not only do you see this pitchfork totally controlling price, again, a traditional pitchfork, look at the interaction with the median. And then, of course, the upper parallel was just unbelievably strong until it got so close to the 68. It wanted to test the 61.8. It wanted to test the 61.8. Wanted to test the 61.8. Pitchfork finally hits it. Boom. Now, why am I spending time on the Dow? Because here's MultiWave. Single plot, but okay. And you could see the other times where price got high and it turned it around. Look at the low down here. Bingo. Look at the low down here. Bingo. And not only did it get above the infamous 89, at the time this energy point was there and created, this thing is maxing out at 100. Which means what? Reversal. Yeah, Ben Bernanke. So, all technical. You have a pitchfork, Andrew's pitchfork. You have a Fibbo, one of the big retracement reversal, end of retracement reversal points to the pip, to the price point, 61.8, and you have MultiWave. All three at the same spot saying, big reversal coming. But oh yeah, it was actually caused by a glitch in a computer. That is an ooh-ah. MultiWave is very powerful. All right, so you've seen me draw this out. You want to think of harmonic wave convergence a little bit the way you would think about Elliott wave, which is why I drew it out for you the last couple weeks. We don't count waves. It's important to understand the relationship between the upper level and lower level waves. In our example here, the green upper level wave 3 is not terminated until the orange lower level 5 is complete. So the big green can't be finished until that 4-5 move of the orange wave is finished. And the orange wave 5 is not complete until the 4-5 of the red level wave is complete. But when they all complete and meet at the exact same spot, you're going to have a reversal. And because that last red wave is of a smaller length, do you understand now how we can have accuracy here within a zone? If we only could rely on the green wave, remember we just saw with the examples of stochastics and MACD, there's big slush. Getting in and getting out, there's big slush. So MultiWave does this for us. And what we do is we go to separate data feeds. And we find the channel for, in this case, the green wave. We find the channel for it. And we find the top and the bottom. Here's the bottom. And it plots it in a horizontal indicator. It found the top up here. Even though this is an upward sloping indicator, it finds the top and it tells us the top. And then it'll find the bottom. When the channel is bottoming out, the indicator says it's bottoming out. Again, this may look like it's just copying the price channel. It's not. We're going into the data feed. We're finding the strength and the exhaustion points of this. We created these lines, not on the chart, but in our programming. We found these lines. They're not on the chart. But it takes that channel that it found, it flattens it out in a horizontal way and gives us tops and bottoms of the channel. So then, guess what? We go to a lower level wave and we do the exact same thing. Here's the green channel. We found a top. The programming found a bottom. It finds a top. There's a bottom. Finds a top. And it shows us that right here in our indicator. There's the top of the channel. Doesn't matter whether it was high or low or whether this is 5 pips of a channel or 150 pips of a channel. This is the top. This is the bottom. This is a relative indicator. It's telling you tops and bottoms. Doesn't matter how big that channel is. So we go and do it for a lower level time period, and then we go to a lower level than that. And the same thing. Here's the top, here's the bottom. Here's the top, here's the bottom. Here's the top, here's the bottom. Now here's what we do that's totally different and nobody else has done, and quite frankly, I'm surprised, having had this out now 7 years, that nobody else has figured this out. What we did then is pretty special. We take that data. Now remember, I said this the other day. This is pretty cool. See, once you get it in this indicator, and remember, this is a relative indicator. It doesn't measure absolute prices. It measures relativity. This is the bottom. This is the top. And that's what it shows you. Bottom, top. But this point right here, there's your time. Here's your 0 to 100 scale. So that point right there occurred at 10:31. a.m. And that point right there was 49.37. That is an XY coordinate. I could go to any chart in any time period, in any relative indicator, and find 1051, 4937 and plot it. Which then gives us something kind of special once I realized that could be done. And now we're going to take all those different channels, and I just overlaid them on top of each other. Here's the big green channel. Boom, boom. Here's the big green channel. That's the channel that the big green arrow was in. And then we went and found the orange channel. And here's the orange channel. And then we went and found the red channel. And you'll notice something that happens here, because we can superimpose those onto a time period, like a 1-minute chart. When they all meet and converge, it's at a single point. And what ends up happening then is your indicator will show all the waves. They were flattened out, and all we did was take their time and point value and put them all in one channel. This is multiple time frame wave exhaustion in one channel. So I can see the green wave, I can see the orange wave, and I can see the red wave, which kind of fades into a pink here. And when that last red wave gets up there and meets the orange wave and meets the green wave at 89, we have a reversal. All right, so this is the orientation you would have to duplicate what we're doing with MultiWave. First of all, you know, what strength indicator are you going to use? RSI, stochastics, MACD, something else? You know, what I found out that RSI was close to being pretty good with some short level indicators, some short level presence, but it wasn't good enough. So, you know, we tweaked and we tweaked and we tweaked, and we created something better than RSI. So now we have the best strength indicator per time period, but that's not enough. What you see here, if you look at the labels, these are my old pro charts. 4 hour, four hour, 30-minute, 10-minute, 5-minute, 3-minute, and 1-minute. So we know now through Elliott Wave and through the transferring Elliott Wave's conceptual structure to MultiWave, we now know that the upper level waves will cascade. They will fall as soon as the lower level wave next to it and the lower level wave next to it and the lower level wave next to it falls. So that's not too hard. All you have to do is look at 6 time periods. Tell me when this thing is at 89, you know, when this one might be at 89, you know, when this one might be at 89, and, well, wait, we got to wait for this one to be at 80. But is it that one or is it this one? I'm not sure which one to, oh, and then when this is at 89, oh, maybe it's this one, and when this one is at 89. Do they all match up? Do I really know which one it really is? I could put a current cursor on it, maybe. But remember, there's big slush up here. How many 1-minute candles in a 4-hour candle? Remember the math? How many 1-minute candles in a 4-hour candle? Now this 4-hour candle here, how many? 4 hour, 240. There's not 240 candles on here. And yet I'm going to try and figure out which one of these tops is the top that I'm looking for. And I don't even have all 240 here. I'm trying to find which one of these tops is going to match up with this one. Are you kidding me? So if you have the eyes, the computer setup to where you can see this big enough, because you probably wouldn't want to put more than two on a chart, 2 charts on a page to have clarity. And then you have the ability to scan those 3 monitors in addition to whatever else. Well, that's your way of doing multiple time frame analysis. Or you can take all 6 of those and put them into one field. Again, I warned you, the patterns are going to look strange to you because you've not seen an indicator like this before. Don't worry about that right now. We'll show you the patterns and the plots and what to look for. But the one thing I want to show you is the accuracy of the waves in real time. So remember, on the 30-minute MACD and the 30-minute stochastics, every little tick on that chart was measuring the 30-minute wave, and that's why it didn't match up with the 5-minute MACD or the 5-minute stochastics, because each one of those was measuring the strength and the exhaustion point at their local time period. When we can combine through programming, finding the channels, finding the tops and bottoms, creating the plots, and then we can take those plots and overlay them on each other, they should still read the same no matter what chart I put it at, because, 47, whatever it was, 49.37 and 1031 are found on all charts. So I just plot that same point on all charts. And this is why the blue wave here is the 30-minute wave. We have here a 30-minute chart. We have here a 1-minute chart. The blue wave is the 30-minute wave. And what I'm showing here is, at this given time, the blue wave measured 29.73. Here's the blue wave, and it measures 29.73. Ooh, multiple time frame analysis. I am reading the 30-minute wave on my 1-minute chart. And it is just as accurate as it is on the 30-minute chart. How many times I've seen in Facebook groups, well, I got to go look at the upper level charts to see what they're doing. No, you don't. You got it right here on your 1-minute chart. So, quick poll. Who here right now regrets paying for this course? A little bit of a teaser question. Right? Now, we're going to learn MultiWave first, but then we're going to bring tab 29 to you. And in not just because I want to use it promotionally, but just understand, in reality, tab 29 is what you see right here on steroids. So I spent the first 7 years, getting to a point that I had the knowledge to be able to build this out. Then I spent 7 years trading this, learning its strengths, learning its weaknesses, and then just literally giving it massive shots of steroids. And now we have tab 29. Legal steroids. All right. So there again, just blown up a little. All right, so I'm going to refresh real quick. Those of you who've seen this before, it's a refresher for those new. This is just a way of understanding the slush at the upper level and why you need to drill it down to the lower level in order to trade. So I call this the box, and hence this next segment, understanding the box. If we look at a 30-minute wave and we look at, statistical averages, I can tell you that the average 30-minute wave is about 72 pips. The average 10-minute wave is about 26 pips. It's about half. And the average 1-minute wave is about 7 pips. So what I mean by that is if we were to look at this from an Elliott wave perspective and the 2 to 3 move, well, there it is, 72 pips at a 30-minute level. Underneath that, the 10-minute wave is about 26 pips. Now, these are averages, obviously. They could be much more, much less, but this is just what it worked out at the time I did this part of the training. And the 1 minute, about 7 pips. So what you have to understand then is if you draw 3 boxes and draw them to scale, and I make them 72 feet square, 26 feet square, and 7 feet square, and I blindfold you, and I'll pick 3 of you, and I blindfold you, and I put each one of you in the center of each box and tell you to find a tennis ball, little gold yellow tennis ball, and I'm going to give you some relative directions. I'm going to tell you it's in the upper left, if you're facing north, it's in the upper left quadrant of the box that you're in. And whoever finds their tennis ball first wins $1 million. Which box would you want to be placed in? Right? Kind of amazing how that may be the case, but everybody wants to trade in the 72 square foot box in the Forex, because that's where the big pips are. I mean, 72, so he's 36 feet flat up, flat out. I don't know my right triangle distances, but, it's probably 50 feet to this corner from the center. He may or may not be able to see the tennis ball. Depends on how tall the grass is, right? This guy might be able to see. This guy doesn't have to move. He's just standing up. He looks down. It's just a yard over. He could reach and pick it up. Or a meter, for those of you who are non-US. So if you haven't guessed it, these are representative slush zones for the waves. What that means is, even with MultiWave, when I have price hitting the 89 value on my 30-minute chart, there is slush, meaning this entire range represents where price is hitting it right here at the 89. Maybe price is going to turn around here. Oh, maybe it's going to go up 5 or 7 more pips. Maybe it's going to go up 15 more pips and then turn around. That would all be hitting where this line is hitting the 89. It's just slush that have to happen at the upper levels. If I drop down to MultiWave 30 on a 10-minute chart, or a smaller box, a 10-minute chart, the box is much smaller, but I still have slush. Meaning, if I'm showing, if I'm showing price tagging my 89, well, maybe it's going to turn around here. Maybe it's going to turn around here. Maybe it's going to turn around here. That would all essentially be this line at the 89. That's the kind of slush you're going to have at that level. This is the kind of slush you're going to have at this level. This is why if you're using a 30-minute chart with old paradigm indicators, you have slush, and why you have to have 50, 60, 70 pip stop losses. There's just no accuracy. You get down to 15-minute, well, you're kind of getting tighter. 10, 15-minute charts. You get down to a 1-minute chart, when the white line is hitting the 89 indicator, it might turn here, or it might turn here, or it might turn here, but that entire box is barely 2 pips, 2 to 3 pips maybe. So if I were to try and make a turnaround determination because, oh, my blue line has hit the 89, that's how much slush I have to deal with. So if we look at as 30, 10, and 1, you can see where the accuracy comes in. Any number of places that 30-minute wave could turn around, because that's how that 89, while it looks like a singular line in terms of price turning around, there's the box it can turn around in. There's just slush. What happens when you go to 60 minutes? What happens when you go to 240? Yeah, definitely. We often say that, David, that the 1 minute chart is your microscope for what's going on. So kind of already explained this, just giving more graphics to bury into your subconscious for your RAS. And so what happens then is, did I not combine these? Hold on. Guess I didn't. So what ends up happening then is when the 89 is here and the 10-minute or 15-minute is there, we've automatically brought this level of accuracy to the 30-minute slush. And when we bring the 1 minute wave here, we now bring the accuracy of that 2 to 3 pips on the 1 minute. We bring that to determine where the 10-minute is ended, and we bring that to determine where the 30-minute wave is ended. So instead of having to have that big slush box, which represents one indicator at time period, whether that's RSI, whether that's MACD, even if it's MultiWave, there's slush at those time periods. But now we get to have precisely know when that ends because the box around it is now only 2 to 3 pips. Does that make sense? Do you grasp that as a concept of how we eliminate the slush at the higher level? And again, nothing brainiac, guys. I mean, yeah, it was a good concept. And, and I have to laugh because it took 7 years to go from Elliott wave to this at a conceptual level and then figure out how to do it on the charts. But it's not brainiac at all. It's just plotting an XY. Anybody could plot an XY point. And yet 7 years after I did it, nobody else has done it. And even if they did, we're another 7 years ahead of them because tab 29 will blow anything out of the water. So we can, as I showed it here, we brought all that up. That's not how it works. We bring it down. So the 30-minute wave is now in here in this box. The 10-minute wave is now in here in this box. And that's why we make a reversal in 2 to 3 pips, because we brought the other waves in here. And what you end up with then is MultiWave, which you'll be trading, and then the teaser is tab 29. And I'll tell you why tab 29 is so cool. Because what you have here with MultiWave is this is a strength indicator I created that, in my opinion, is much better than RSI. And I think RSI, in terms of a turnaround, is as good, if not better, than stochastics. And they both are much stronger than MACD or other strength indicators. But that's still one formula, one plot. In this case, the 10-minute wave is the same thing, just applied at the 10-minute level. So it's still one formula, one plot. And the 1 minute wave, same thing. It's the same formula, but applied at the 1 minute level. Tighter slush, or less slush, but it still is only one indicator. So even when I put them all three together, I literally have three different indicators from three time periods. You know, three single indicators from one single indicator from three time periods give me three plots. Let me put it that way. Okay? That's MultiWave. Where are you going to go to after MultiWave? And no, you can't skip it. So I'm going to tease the hell out of you, and I shouldn't do this, but I got to have some fun. So I'm going to tease you, and you've seen this picture before, but now I'm going to explain it to you. So here we have a 30-minute chart. There's a pitchfork. This is obviously on TradingView with visibility turned on. And I see that pitchfork hit. Well, I see the pitchfork on my 1 minute chart. Okay, this is an insert or an inset. And there's my pitchfork, and there's the median of my pitchfork. And you can see this 30-minute bounce or this 30-minute hit on the pitchfork. Look at that. Thank you, TradingView, for visibility. Look at that 1 minute candle hitting that. And these are 5 pip channels between the white lines, horizontal grid lines. Now, let me tell you about tab 29. This down here is tab 29. Now let me tell you about why it's so powerful and why it's called tab 29. Anybody know why it's called tab 29 besides my Pip Club traders? Anybody? Have I shared it yet? So tab, yeah, stands for tops and bottoms. How creative. Okay. Tab, tops and bottoms. 29. This indicator, which is my 1 minute tab 29 indicator called peak, that indicator, as it appears as a single plot, has 4 indicators that are weighted and averaged, including my proprietary MultiWave indicator. It has 4 indicators that are averaged. So when it says I'm at a top, it's 4 experts agreeing, not just one. My 30-minute indicator in blue also has 4 experts in it. My yellow wave is different because my yellow wave consists of 4 indicators at the 10-minute level and 4 indicators at the 5-minute level. And 4 indicators at the 3-minute level. 12. 12 experts saying the 10-minute wave has got to the top or got to the bottom. You see this green and red area. There's really 6 bars there. We've kind of scrunched it down so they bleed into 1 bar. There's 6 bars there. The first 5 each have 1 expert. The last bar has 5. Oh, excuse me, the last bar has 4. I'm making this better than it is. I don't need to do that. The 6th bar has 4 indicators, 4 experts in it. So 1 times 5 equals 5 plus 4. There's 9 indicators in those 6 trend bars. And so I have 4 plus 4 is 8, plus 12 is 20, plus 9 is 29. So you look at one indicator channel in tab 29, and there are 29 indicators working for you. And if I don't get a stream of ooh-ahs in about 5 seconds, I quit. And this is why, I'll tell you how you read this real quick. We have all 3 waves past an extreme. The 30-minute wave is actually what we call snaking. It's at the extreme, but it's kind of running flat. The 10-minute wave goes way up to an extreme. The 1-minute wave goes to extreme. All we're looking for is the 1-minute wave to leave that mess, that convergence. We're just looking for the 1-minute wave to leave. That means we've hit the top and now we're coming down. And for those 9 experts to agree that that's the time of the reversal. Not 5 out of 6, all 6, which represent 9 separate indicators. See, it's a complementary indicator. It's in addition to this. It's 2 separate teams of judges, and they both have to agree. This one has 20 judges. This one has 9. And so right here on this red candle, when it closes, and all these are red, we have our entry. Now again, look at the scale. That's 5 pips. How big do you think that candle is from the top of that tippy tip tip where it touched? It's actually 3. It's like 2.7. So you got in this move in 2.7 pips. And I'll tell you later why our stop loss is just 1 pip on the other side of this pitchfork line. So you have 2% to a 10 pip stop loss. But if you lose, you don't lose 2%. You're losing fractional percents, like somewhere around 0.5, 0.7. So you're only risking 0.7%, but yet as you gain, you're gaining 2% every 10 pips. It's actually a 1 pip on the other side of the convergence point. You usually enter 2 to 3 pips into the convergence point, so the stop loss technically is about 3 to 4 pips. Now, who could tell me why we can get away with a 1 pip stop loss on the other side of the convergence point? See, your RAS already knows this. Yeah, accuracy, precision, entry, wham, 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 wham. What's the technical reason we can get away with 1 pip? Yeah, it's a live indicator. So here, yes, Barry. Well, if you could be more specific, I'll give you the cookie for the night. Lots of good, less slush, good indicators, end of a wave, blah, blah, blah. Nope, didn't get it quite. I thought you had it, but you're real close. So you all are going to have fun with this because I'm going to give you the answer, and you're going to go, oh, yeah, I knew that. And what is that an example of? RAS. Right now, your mind's not capable of calling up what you already know. That's RAS. This is why green traders who have this absolute, oh, I got that. You have to trade in order to get your RES to function. You ready for the answer? Who's ready for the answer? Tell me yeah. Or should I just leave it till after Christmas? All right, here you go. Now, all of you who honestly go, crap, I knew that. I want you to tell me. Drop your ego fence and tell me after I show you this, you're going to go, oh, crap, I remember I knew that. So wild guess is coming on. I'm trying to get it before I show it. I love it. All right, here we go. Here's the RAS buster for the night. Elliott wave. X, which represents the hard move. I go up to a 1 wave. The 2 wave can only come down to there. If the 2 wave goes below it, this was never a reversal. It was a retracement and a continuation. The 2 wave cannot go below the start of the 1 wave. If it goes 1 pip lower, it is no longer potentially a 2 wave. We have no trade. So we could get to the convergence point and go 1 point below it and be safe. Oh, excuse me, right here. We can be 1 point below it because we know this pullback to 2 cannot go below that point. If it does, we were wrong in the trade to begin with. And guess what? If we're wrong, why do we want to wait till we get to 10 pips? We will take ourselves out there at -3 with spread -3.7, -4.2, whatever. We don't need to bleed off 10 pips. We use the dynamics of Elliott wave structure where we know this hit here is going to be an impulsive move out, and that's a 1, 2, 3, 4, 5. So these people, I mean, I have to laugh. The people that sit here and, oh, well, that's my entry point. That's my strong support line. And yet they have these, 30 pip stop losses. Holy crap. If this thing really is going to reverse, it has to do it within 1 pip of that line. That's the term, Emundo. I knew it, but it didn't come to mind. So that's an RAS growth. So that's how we do it, because we can, with precision, so some of you were like on the verge, we can precision determine this point, and we allow that precision to say, well, you know what, we better not get too greedy and take the trade just because it hits that line that we think is the convergence point. We need to see it reverse in our direction. 2 pips. Which is why when you enter at 2 pips and you have your stop loss at 1 pip below, the average stop loss is -3 outside of spread. Questions? Yeah, Zoe. So somebody's saying it looks too easy. It's not easy, and the thing is, remember what I said. When this happens, when the wave gives you this kind of entry, it's It's that precise. Okay, so here's a, I saw that before. Sorry I didn't answer it. So, honest question, with tab 29 being so powerful, could we just trade the indicator without pitchforks? Just curious. I know the more we have, the better the probabilities. Well, remember, what we like to see is a wall that we're bouncing off of that we can apply this. So, case in point, what happened here? These are real charts. Nothing was graphically edited in these charts, by the way. The only thing that was done was I put the arrows on and added the box and cut and paste the one and put it on the other. What about right? I don't have a good vertical tool, but I think this is close enough. Why wasn't that our trade? Two reasons. The first one, we have a median there, and we would suspect price would be attracted to it, but that's not it. Maybe we said, well, I'm going to enter early just in case it doesn't make it all the way there. Remember, we're 5 pips away. These are 5 pip channels. We're 4 or 5 pips away. So we have a hook back. Boom, right there. It's just at the time of the hook back, did we have 6 red bars to confirm that we should take that sell right there, which would be on that candle? Nope. Tab 29 to the rescue. The 9 experts up here said, I know you're hooking back. I know you think this is the end, but trust us, it's not the end yet. I've seen this so much on 15-minute scans, it's not even funny. Oh, it's almost at the green line. I better take the trade. It's 3 pips away. Suppose it just goes from here. And well, we know it's supposed to touch the green line, but to help offset that, you're going to have this reality. Maybe the 1-minute wave hooks back a little, but I don't have red to tell me to take the trade. I have to wait for the 6 red bars. Then the pullback is validated, and I have my trade. Oh, there's lots of ways to exit, and it's a myriad of possibilities. So don't worry. That's why you're in this course. But you ain't going to get it Friday and trade it Monday. There's a lot to learn. Say the entries are the least test of your head game. The exits are the big test of your head game. The entries are not hard. The exits, they're not hard either. It's just your choices will have your head spinning. So we'll pick some and do that. Now I want to check something. I was going to wind this down, but I want to go maybe 5 more minutes, and I just want to check something. Give me a second. Okay, so I've got a trader I've been working with. And he's got a kind of crazy work schedule, and he's really had a bad year. He's an Aussie, and I don't know all the circumstances, but I think like in the last 3 to 4 months, he's had 3 good friends commit suicide. And so his head's been all over the place at a time when he was really supposed to be, like finalizing what we're doing with our training. Yeah, real bad. And so anyway, I'm not giving anything away because this is public in our groups. It's just you guys aren't part of this group yet. So I'm going to bring up a Facebook page. And I'm going to go, this is in our Tab 29 Traders group. You'll eventually be part of this, okay? And I'm going to go through these trades one after another that you can see are all recent. 28th of November, 20 hours ago, 28th of November, 27th of November, and then November 11th. So let's just look at these last few trades. And that's because I had a comment on it. November 28th, etc. So let's go through these trades. And all I'm going to do is get to the, plus 20 pips. Okay, you can see the entry at the green line. All he did, tab 29, 10-minute convergence, 30-minute convergence, 1 minute leaves it. He has green. He enters the trade. In this case, don't pay attention to the exits, but he's exiting up in this area. I'll tell you why he's choosing to do that. 20 pips. All right, that was the first one there. Second one. 6 pips. Same thing. It was just a small move, so he still got 6 pips out of it. 20 pips. Same thing. You'll notice the patterns repeat themselves. 1 minute comes down, it leaves, finally got the green arrows. Hey, what about this 1 minute move beforehand? Nope, didn't have green arrows. Green bars. 20 pips. 1, 2, 3, 4. 14 pips. 8.2 pips from the trade station, so spreads included. Next one, 23.2 pips. 5 pips. 35 pips on the charts. These are the trades he brought to me yesterday for review for our coaching session. 4.2 pips. Yeah, Zoe, for sure. Yeah, what a turnaround. 18 pips. He's got a loser in here somewhere. I'll find it. 6.2 pips. Is that the same one? 7.8 pips. 28.5 pips. Do I have to keep going? He's doing the simplest approach to tab 29. 8.2. I'll find it somewhere in here. 10.2. Now we go back. We're right at the fringe of our last period, which I think, yeah, this is the last one. Maybe this is it. Nope, 10.2. I'm going to drill down. I'm going to find it. He did have a minus 2.6 in here somewhere. 14.5. I'll just keep going. So I got traders who are trying to do so much. See, it's a very powerful indicator. 33.2. Now let me tell you, that's the same one. Let me tell you, Trent, 9 months ago, wasn't trading. 24.2. Dang it, I'm going to find it. I'm pretty sure it's a minus 2.6 somewhere. 7.9. These are all just baby 10-minute trades. He's found his niche. 11.2. I'm going to end there. So you can have really high percentage wins, really tight stops, and he's found his little, he knows what he does. He's got his rhythm down. He knows what he wants to do. And so he's not unusual. What Trent has done that others who are taking, my instruction, where they're weak, where they're not as, where they'll have a few more losses, not tons, is the head game. They're trying to do too much. It's, it's like, look, if you go into the candy shop and you like licorice, why don't you just get your licorice and get out? Why are you going for the hard suckers and the Tootsie Rolls and, get your licorice and get out, or whatever else. Yeah, it's part of shiny object syndrome. There's so much that this indicator empowers you to do that you do have to make choices over what you want to do. And he's just found a very tiny niche, and he just, So what I tell my traders now, who I see are scattered, who are trying to do too much, I just, now see, this isn't the first 2-week period that those trades look like that. We've been going on like this for a couple months now. And so and traders are recognizing it in the group. They're like, dang, Trent, Mr. Consistent, blah, blah, blah. And so what I tell traders now who have lost focus, who are trying to look at too many things, why do you look at too many things? FOMA. You're afraid you're going to miss something, so you go, shiny object. So what I tell them now is be the Trent. Be the Trent. It's my new cliche, my new little saying. Be the Trent, meaning just stay focused. Just do something. There's 10 different things here you could do to make tons of money, just like Trent's doing, and much more. So, here we go. So we've got to go through MultiWave, because MultiWave will teach you the relationship of the waves. I wanted to tease you a little to see where you're going. And I'm moving through this as an accelerated fashion. Zoe, Glenn, Richard, got a few Pip Club traders in here who know, because, prior to tab 29, it was a long, arduous course. It was a long, arduous course. And path, journey. And so you guys are going through it at an accelerated pace. Partly because I've changed my training philosophy a little bit, and so the new training style, if you will, is allows things to be accelerated. So if you hang with me, the majority of you will be able to do what Trent's doing. No doubt, at least in February. And if that's too long, I'm sorry. But you're going to have to do your work. You're going to have some pain. You're going to have to get over your frustration, because you have a lot to learn, and therefore when you trade in post, you're going to get frustrated because it's going to be loss, 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 loss. Trent is here to tell you that turns around as you learn by posting your trades. And, there'll be further instruction. I watch what the group does. This is a smaller group. And I watched, and I can tell where instruction is needed, where I have to remediate. I'll have fun with some of it, just like I did with the why can we get away with one pip, and nobody got it because the RAS was focused on so many other things. They were screening out what they already learned less than a week ago. RAS is a beast, guys. And I'm a real good judge at where your RAS is. You just have to listen to me, and I'll get you there. This little program here, the Precision Traders Group, is going to be my master trader factory. So just hang with it. All right, so I was targeting an hour and a half. Here we are, pushing 2 hours again. My bad. This video will be up and posted, and it will be put into the PTR sometime later tonight or tomorrow morning, my time, Pacific. I appreciate you carving out some time to be here right now. The holidays are upon us, so be extra careful when you're out and about. And so I'll close by reminding you, I will see you on, Tuesday morning, my time, Pacific time. And the weekend is here, so life can be short. So for those people you care and love, please let them know you care and love them. Even if it's just 1/10 as much as I love you guys. Have a great night and a good weekend. See you guys.